Thanks for being on, everyone. We're really excited to have the IPA team here today, and they're one of the it might be the largest, but they're definitely one of the bigger movers in the DFW market. So really excited to have William and Harry today. So I'll kick it over. And Hayden, I don't know anything else you want to kind of mention, but yeah, just really appreciate you guys being here today.
Yeah, I'll just add real quick for everybody that's with us, we will send out a recording after the fact. So if you miss anything or want to see the slides again, we can definitely share. But yeah, excited to have William and Harry here with IPA to kind of go through what they're seeing in the market. There's been a lot of changes, a lot of turbulence. So excited to hear what you guys are seeing on the ground level, talking to buyers and sellers.
Yeah, absolutely. First and foremost, really appreciate you, Dustin and Hayden, having us on. I know we've been closely working together over the past couple of years, so have a lot of respect for what you guys have been able to do in the market, and hopefully we got some insight, and happy to kind of cover any topics that you guys want us to cover on. On the call is myself. I'm on the Institutional Property Advisors investment sales team, and then Harry, I'll kind of let you introduce yourself. Harry's on our debt side of the equation here internally at IPA.
How's it going? Can you guys hear me okay? Sorry, I was having a little issue with the audio there. Good to go? Awesome. So I'm Harry Krieger. I sit here in Dallas with William on the IPA capital market side. Our group is kind of a arm of IPA's broader umbrella, particularly doing a lot of debt execution, a little bit of JV and equity, and prep, but the focus of the core of our business is multifamily debt execution. We help service particularly William's team here in Dallas, all the other sales teams out the country, in providing an execution that can staple in pretty well with their high-end product they sell. Probably doing $2 to $2.5 billion a year in the multifamily space, a lot of which is agency. So see plenty out there in the market and can happily answer what we're seeing, what's going on, and really appreciate you guys letting me come on here and give a few words.
Yeah, and as far as our team goes, for those who may not be familiar with our IPA platform here in DFW, we are the largest multifamily investment sales team in all North Texas. We have a total headcount of 20 people sitting here in our office here in Addison. We're located right across right on the intersection of Spring Valley and the toll road. DFW is kind of where we plant our flag. Our team consists of 8 producers, 3 junior producers, and 5 senior producers, and then 12 back office staff where that really makes all the magic happen. And then Harry and his team are bolted on, and we kind of run a tandem with each other every step of the way. So I figured, Dustin, this is kind of the slide our first slide we have up, just a DFW overview. I figured it would just be maybe helpful, happy to kind of give it a little bit of insight, talk about what we're seeing the large motion picture here in DFW and how we kind of expect this year to play out, if you guys are okay with that.
Yeah, that sounds great. Perfect.
So I feel like we are coming out of probably one of the most dramatic and rapid downturns in multi-investment sales history. I mean, just given the volatility in the market, as well as volatility on the capital market side. Thanks, Harry. Especially just given coming out of a very challenging year operationally in 2024, to no one's surprise, that has created a lot of pressure on existing capital stacks, as well as put a lot of downward pressure on pricing. I guess the good news is that DFW is further along on the supply story, as well as has one of the best supply dynamics of any market in the Sun Belt. So if you look at urban Nashville, Atlanta, Phoenix, Austin, you're going to notice a lot of those markets are not going to be hitting peak supply and record supply until later this summer, or currently going through peak and record supply right now. So we anticipate there's still a lot more softening and some hurt coming in those markets. And also, too, the fact that they've delivered a way higher percentage of inventory given this most recent supply surge. DFW, we hit peak supply in Q3 of last year, so we're 6 months past peak. And in 2024, we delivered, had 44,000 units open up their doors. That's the highest delivery year that we've seen since 1984. On the other side of that coin, demand has been nothing short but incredibly impressive. We've seen absorption demand be right on top of that number, and that 44,000 unit wave getting absorbed at a very, very impressive rate. Actually, a lot of the projects we have signed up right now are 2024 construction that were as a part of that wave. And we've actually seen many of those projects hit stabilization, have a fantastic lease up velocity, and hit stabilization sooner than originally anticipated. That also correlates with DFW being, we're still leading the charge as far as net immigration into the Metroplex, as well as that's kind of coinciding with single family home prices. 4 years ago, our mean pricing for single family homes was $290. We're sitting today at $415. So just from a necessity standpoint, we're seeing a lot of push as far as more renters entering the market. And we expect demand to kind of maintain at that steady course and be at that record high. And however, on the other side of the equation, on the supply side, we've seen a lot of developers, especially merchant developers, not really being able to complete the capital stack and put a pause on putting shovels in the ground, not due to the supply, but more so due with how much construction costs, as well as correlating it to their exit price and what things are trading for today. So due to kind of the capital stack turbulence on the development side, we've seen a lot of people put a pause on putting shovels in the ground. So we're going to be going from 44,000 units in 2024. This year, we're going to be delivering about 32 to 33,000 units. And then next year, we're going to be bottoming out somewhere plus or minus 20,000 units. That exact number kind of depends on some of these projects opening their doors in Q4 or Q1 of next year that we're keeping a close eye on. With that being said, the overall consensus is last year was very challenging operationally. And I think there's no coincidence that was because although there's a demand for that 44,000 unit deliveries that we had, that still puts a lot of pressure and strain on our market as a whole. So we've seen some uptick in vacancy. We've seen concessions make its way down to workforce housing product. And we've seen just a lower high quality foot traffic count across the board. I think what you're going to see as we enter throughout the remainder of this year and into next year is you're going to start to see green shoots. And with it correlating with the supply pipeline winding down dramatically, you're going to start to see green shoots. I think we're going to see a pullback of concessions. I think we're finally going to get some top line rent growth. And I think in a year from now, we're going to be looking up at a very positive trend line T12 on a lot of these projects, as opposed to what we're seeing right now that's relatively flat. And I think all of that, going back to my main point, I think that all just correlates with the supply and demand dynamics that we have here in DFW. As far as capital, we are seeing every bucket of capital be incredibly active right now. Institutional capital re-entered the market last summer. It's been really full throttle ever since they re-entered the market. I'd say the first domino to fall was when Blackstone came out and publicly announced bottom, then followed up with purchasing Amco for $10 billion back in April of 2024. Soon after that, we saw a massive flood of institutional capital back into the market. Kind of slowed down in Q4 of last year, given the rising treasuries as well as the election, and then picked right back up during NMHC earlier this year. Their execution strategy has been, they're kind of open to all options. From a debt form execution, we've seen a lot of institutional capital go private debt funds, LifeCo, or agency. We've also seen them be open to different investment strategies, whether that's chasing basis, high yielding in-place deals, or just overall IRR returns. Most of them are wanting to be concentrated in the 90s and newer space. However, we've seen a few of them kind of swoop down into the workforce housing space, thinking and with the mindset that they could kind of time today's market, seeing that the lane is more open within workforce housing space, and also time today's market where they either buy a way more high yielding deal on in-place numbers or a really good basis and a little bit more to choose from. More specifically within the 80 space, just because the 80 space is so hard to ignore here in DFW because it does make up about 27% of our inventory. So although we get group sales all the time going for 90s and newer, they always keep it open to 80s product. On the private capital side, they've always been open. They've been active ever since the market started to turn in 2022, but they've been very selective at the same time. We've seen recently that they are incredibly agency sensitive, and the main metric that they're using right now is solely cash on cash or positive leverage driven deals. So I know that was a lot of words and a couple quick data points that I kind of pointed out and a lot of topics there. I guess, Harry, any insight from your end that you want to shed light on as far as what we're seeing on several of our projects on the debt execution?
Yeah, no, happy to chime in. And William, you did a good job with the 30,000 foot with how debt's kind of shaping out today. You know, everybody, as far as all the different lending sources are liquid and out in the market today, I would say a good word to describe kind of the volatility and how they react is shifty. So, you know, we rewind pre-Liberation Day to that first week after, treasuries were a huge factor in a huge upswing in an agency business, with their volume, you know, looking faster than pace from the last 12 months, you know, in a larger vacuum. You know, now treasuries have run again, you know, stuff with tariffs and different macro events impacting the indices has caused a pretty substantial run up here in the treasury in the last, call it, week plus or minus, which has caused a little bit of stall in that inflow volume on both the Freddie and Fannie side. Year to date, they still have a ton of money to put out. You know, both of the approximately $70 billion of cap given. They're at April numbers. Freddie's around about $18 billion in business done this year, and then Fannie's around 17 and a quarter, 17 and a half. So a substantial amount of dry powder still in that space. You know, those guys are the kind of the foundation of liquidity for a lot of the multifamily market, and they will find ways to get deals done if there's a continuance in the running of the treasury. You know, as far as spreads have, on a general, if you zoom out kind of year to date, come in, you know, post-Liberation Day, same kind of thing. There was a bit of a springboard reaction, or I would say they came out plus or minus 15 basis points, and that's trickled back in again to maybe more like 5 to 10 out net from prior to that date. So, you know, all things considered, the spreads are holding relatively steady in that space, which is solid. You know, with treasuries running, things like if you have a good sponsor in the mix on a deal to get things done, to get leverage to a point, as William mentioned, you know, positive leverage is important. They're close to neutral, or at least getting out in the first year to positive leverage. Things like a 35-year amortization, other tools, we're pushing IO to try to get that last kind of leg ahead to win a deal with the competitive broader market still out there. You know, when treasuries continue to move, the volatility is there, and it feels like not a great fixed rate market. Debt fund lenders have been prominent this year to date. I will say their start to the year was much more hot and substantial than it is year to date right now. Again, post-Liberation Day, with some volatility shaking into their markets. You know, start into the year, you know, good products, 65% of cost to 70. You're seeing the low to mid 200s on spread. That, you know, broadly across the spectrum is probably 25 to 50 basis points wider year to date today. Looking forward to where we are right now. So you're still getting a lot of liquidity in that market. I would say they're a little more cautious. They're still trying to get money out the door. Metrics have moved out as well on going in debt yields and exit debt yields minorly to kind of account for that, as well as, you know, picking and choosing a little bit on vintage. So, you know, some folks that would be very, very aggressive on your typical 70s deal in debt fund space, maybe more in the 80s and 90s space today to kind of, you know, insulate from what they've been seeing as far as what the trickle-down effects that Williams has mentioned with some concession and just general volatility in the market. So they're getting a little more core in their debt fund buckets, if you will. That's not to say that's not, it's unavailable, because a lot of these people have plenty of dry powder still hanging out in the sidelines today. If you move up the curve into the newer product spectrum, we're seeing life cos still be active. If folks are chasing lease-up deals, that is where we're seeing them and the agencies kind of butt heads the most, as they're able to say, hey, this is newer product. We like assets, with longer-term holds that have that kind of broader band spectrum view on how we kind of treat our debt. We're okay going in at, say, 75% occupancy, 80% occupancy today, and putting a profound fixed rate quote out. Now, 5-year money in that world has become a little less available and a little wider in pricing. But if you have longer tenured money, 7 and 10-year money, for example, is your ask, that pricing is held relatively solid and hasn't moved out to quite an extent, some of their peer sets. So between that and then the agencies as well, they are hungry for longer term debt. So if you do have a deal that you want to hold for longer term and say a 10-year window, that money tends to be a little bit more aggressive on the spread and in between the lines on term than you'll see on the 5-year. Not to say the 5-year is not very much so available today, because that is still the hot money that's been most often executed on with the agencies and life cos. Happy to talk about banks. They're sort of dipping back in their toes. They want to get back out in the market. They saw a window to kind of, clear out some of the balance sheet trouble we've had in the past. And we're seeing more and more of them show up again. And then that's in two different kind of ways. It's asset-based lending. So, you have your typical, you buy a deal, it's lower, moderate leverage. They put a low leverage, low spread floating on the deal, and, pretty simple transaction. And that's how they're getting money out in that respect. The other way they're doing it is via kind of back leveraging some of these debt funds as well. So that is further kind of pushing that floating rate market. So they may be kind of an A position or a warehouse line to a CLO, but just different mechanisms to get money out their door and keep liquidity in the market as well. So with the volatility, that is very much still there, and treasuries are moving around. But the broader positivity is the market's moving and it's, kind of shifting with it, but they all have dry powder and they all want to keep the lights on and the wheels moving. So I'm optimistic that with volatility dropping, we will see a coinciding with those green shoots that William mentioned a little bit ago.
Gotcha. Well, cool. One question I had, I guess maybe a little more for William, but either of you guys, because I know developers are, like you said, that equity is not there. Are those guys out? Are they instead of developing, are they going to buy because of the replacement cost differential and all versus the build?
Not necessarily. There's a few groups that have a development arm as well as an institutional platform. I wouldn't say it's widely common. Most of the deliveries that we've seen are merchant developers. So it's kind of, that's all they really have known and done, and are a lot of their inventory, probably 80% of last year's deliveries were merchant developers. So you do sometimes get some cross correlation, but I wouldn't say it's very broad.
Yeah, and I think that if the reasoning why the few that are doing it, though, is spot on what you're saying, Dustin, right? So they do see that relative value and see like replacement costs. And of the small group that is doing that, that is a pretty, point A reason that that's going on. So, for those who are doing it, that is reasoning. So,
okay, sounds good.
I'd be curious too. I know, Harry, you touched on from the lender's perspective, it seems like their appetite is kind of shifting towards newer assets. So maybe Harry or William, I don't know if you've seen maybe in the buyer pool too, if any of that appetite has shifted or a major divergence from older stuff to newer stuff.
Well, you can touch on the bid sheet maybe, and that's probably the best way to hammer it, and then we can kind of go back and have a depth really looking at it broadly.
Yeah, absolutely. So 90s and newer, really 90s and early 2000s construction product right now is going to be the most crowded airspace and most competitive airspace for product type. We just ran 8 different call for offers investment finals within the past 10 days. About 5 of those were 90s and newer construction. without a doubt, I mean, we had 290 deals that we had. I mean, we're getting on average 40, 50 tours on that product type, as well as in some cases hitting close to 30 to 40 offers. That's not on every deal, but we do see it, but it's not uncommon at the same time. We are seeing every single capital bucket wanting to be in that space. And I think the reality is that, well, and it all comes down to equity and people's equity partners. I think right now there's a little bit with a lot of people's equity, there's a little bit of a mismatch as far as people that were in the value add workforce housing space wanting 90s and newer. We could definitely make that happen. However, I think there's a mindset that they're going to be receiving workforce housing value add returns, and that just doesn't exist, especially now that we've seen the institutional capital come back in. So it's very competitive. It's a different ballgame and completely different metrics. Where we're seeing the lane be much more open is on the late 70s and suburban 80s product as a result. So yes, very competitive. That's where everyone wants to be, but at the same time, it's going to be much different return metrics than a lot of folks are used to.
Gotcha.
Do you see that
Yeah,
trend?
sorry.
Oh, sorry. Here, I was just going to ask about, do you see that trend continuing, as supply falls off? Because obviously, as you pointed out, we're going to see a pretty dramatic decrease in supply over the next few years. So what does that do to the appetite for some of these buyers over the next couple of years?
Well, I think there's a lot of capital that needs to be deployed. I think what we're going to be seeing is, I think more and more people kind of divert back to kind of my comment earlier, the 80s workforce housing space is so hard to ignore. And even the late 70s, like 78, 79, that's really 80 styles construction, but it's 70s on paper. We're selling 2 of those deals right now. That's a hard inventory pool to ignore because there's just so many transactions each year, as well as it makes up for a little bit over a quarter of our inventory. I think what you're going to see is a lot of that capital chasing 90s and newer. They're not going to win on a lot of the deals that they're chasing after, and then they're going to need to deploy that capital somewhere. And I think you're going to start to slowly see that capital be rediverted back into be selective, but also redivert and keep their options open within the value add space, just given they get a better cap rate, higher yield, or a better overall just pure basis play. On the institutional capital front, we have seen several groups come out with value add funds, thinking that the workforce house are noticing that the lane is open. They're noticing that these quote unquote, stories that everyone's looking for, whether it be a distressed capital stack or distressed deal operationally that can be picked up for relatively low basis, or even a stabilized workforce housing deal at an incredibly high in-place yield that they can't find anywhere else. We've seen a few household name groups swoop in and start to look in that space, and I think we're going to continue to see more of that. It's just my personal opinion. So,
Sounds good. I had a kind of follow-up question on that. I know late 70s, early 80s, you kind of hit on that, but as far as early 70s and 60s product and all that, especially there's some large assets and all that around DFW. Are you seeing much of an appetite on that type of product?
In my career, I've been doing this for 8-9 years now, selling value add deals in DFW. I was previously at CBRE for a little over 4 years, and a lot of the products I've sold in my career I've sold my fair share of 60s deals and 70s deals. I wouldn't say that is the bulk of our inventory by any means. We come across them every now and then. That buyer pool is going to be the thinnest out of them all. There's definitely one-off guys that will pick off a early 70s or 60s deal, but it either needs to be, you need to be showing a 6 cap that it's stabilized or be well north of it in order to get that product to trade, or it just needs to be in a really good location at a really, really good basis in a very compelling story. Those deals are typically, you're not going to have the most success running them to the market, just because at the end of the day, you're not going to have that 10, 15 offers that you might be looking for as a seller, just because that buyer pool, one, isn't there, and two, it's very fragmented. So a lot of those guys that are playing in that space are one transaction guys at a time. And so it really boils down to timing. And what most often than not, when we come across one of those deals, we have a good list of who's looking at that. I think we have a list of like 30 people that we know and trust that will consider a 60s, early 70s deal. And we would just go rifle shoot it to them off market instead of trying to run a call for offers process, best and final that we see when we get a more solid buyer pool chasing after those deals. So,
sounds good. Yeah, I'll move on to the next slide unless there's anything else you guys wanted to touch on the previous slide.
No, this slide we'll keep it quick. This is just a snapshot, kind of to our theme earlier of we're seeing the market kind of rev its engines back up, especially on all fronts. A little bit on the operational side, but two, more so on the capital markets. I mean, just the capital side and people accelerating back into the market. This is a good data point that I thought would be helpful to share. I mean, Q1 in 2024, our team here internally in DFW, we took to market 8 deals and we had 4 closings. In Q1 of 2025, we took to market 15 deals and we've already closed 11. So I think this is just a good little snapshot just to kind of compare Q1 last year to Q1 of this year.
Awesome. I've got a question for Harry, kind of given this slide. With your deals under contract, obviously we touched on there's a lot of volatility in the capital markets. How are you seeing most buyers structure their debt? How are they navigating the capital markets right now?
Sure. So it's the general consistent one is the agencies, but there are a lot of people doing a lot of different things here right now. And so if you want to work from kind of the top down, we've seen a decent amount of people actually in the core institutional frame on newer products go all cash with the assumption that they can put it on a line and then look for, sunnier days with, maybe a Freddie execution or a life company when those spreads come in, along with corporates if volatility shakes out a bit. As you move down, core plus, call it, 2000s and 90s vintage, up until maybe this treasury run in the last 72 hours, the agencies were far and beyond ahead of everybody else. And there was a very common theme there that, unless you maybe had a shorter term fund or a quick flip value add type folk, the agency money just was pricing very well. I mean, it reached, as low as 4 3/4 with buy downs on coupons. And that's out probably 30, 40 on the bottom band, up to the high 5s today. So we will probably see a little bit of a slowdown and shift potentially in that bucket and maybe some folks going to floating rate. But the agencies were the kind of the number one go-to in that frame. And then some folks are doing debt fund execution just if they have a relationship or they need to close quick, and there's other reasons for that. But as you move kind of downstream a little bit into the kind of early 90s, 80s, 70s, back to kind of what we were mentioning earlier, there is a little bit of a pickiness now kind of emerging into the more kind of older vintage, maybe not as, they have 8-foot ceilings, they may have breaker box issues, they may have something, piping, what have you. Some of those debt funds and insurance companies are saying, maybe life's too short, this is a little too old for us. And that's where the agencies are really having to step in and keep liquidity in the market. They are doing so. They will make you, and oftentimes, make sure that you're keeping that product clean and livable and up to standards that they feel spec with the rest of that, average vintage in their, total portfolio. But, there is liquidity down there. It's going to be primarily agency. You will see a few debt funds go there. They'll just price accordingly to get yield. Some of these folks have kind of opportunistic buckets, looking for, call it a low teen to mid-teen return, and they'll price that accordingly to get that by doing a debt instrument where they're a little safer in their position. Now, I think that the way you do it, if I'm a buyer though on a 70s deal, as you look at that agency execution, even today, you still may be at neutral leverage with that, 4.5 treasury on the 10-year. just where cap rates have moved. So it still makes total sense. They are liquid and, open for business downstream and upstream.
Got it. Given this slide, and it's a pretty drastic comparison to this time last year, and I know, we were active in the market late 23, early 24, and it was a pretty dark point in time. So I know there's probably a lot more turbulence on the timelines while you're under contract on those deals. Are you seeing more stability there with deals that are getting put under contract and working towards those closes?
Yeah, we are. It's all equity driven. I mean, I think 2023, we actually just reran the data on that, Hayden, as far as what was our retention rate, as far as getting to deals under contract to close. I think in 2023, we were at 78%. And now we're looking at 85 to 90% on our past 12 months transaction activity. Every now and then we will have one or two deals out of, the couple of dozen that we trade each year that might pop out of contract that we have a rebound buyer that will step in and end up getting it done. On those one-off scenarios that we do see that it's solely equity driven. It's where it's normally at the time, especially right now with equity being so selective, our biggest thing on buyer interview calls and doing the buyer interview process is knowing where your equity is coming from. Everyone says they have equity, but then everyone tells us they have equity, and then 30 days down the line, we're like, how's the equity raise going? And they're like, oh, we're still raising equity. And to our perspective, it's not a lot of these institutional equity firms are not going to be your equity partners on the workforce housing space. So if we get a buyer that says they're looking to partner up with a single large institutional JV equity partnership on a late 70s value add or an 80s deal, that gives us some cause for concern, and we vet them out up front and realize what the probability is of going through closing. There's been one or two deals every now and then that pop out of closing just because the equity wasn't there, and those guys were trying to get JV equity on an asset that JV equity did not have the appetite for. So.
Yeah, and I guess on the debt side, on that timing frame, it's been quicker recently. I think it is coinciding a bit with, treasuries. If the treasury is running and goes down, in turn, a lot of these lenders get busy quickly. So, as it stands today, William can kind of attest to this. It probably will feel a little quicker in execution, flat-footed today. If you rewind it back to maybe call it September, October of last year when we had the huge treasury run, large inflows to the debt side, that was oftentimes the last component that was holding up a closing. So, William's spot on otherwise, but there is that asterisk as well as the debt execution. Typically, pretty steady and stable, but when those treasury runs happen, we do kind of advise folks we're working with to buffer a couple more weeks, oftentimes, just to make sure that they're not sprinting at the last minute to get something closed and do anything they wouldn't want to do.
Yeah, and Harry, that's a really good point. Harry and I, we actually just closed several deals with Harry's team, and there's two of them that the buyer had to extend a little bit outside of contract, just given some of the nuances as far as amendment on the debt side. They ultimately ended up getting it done, and it was one of those conversations where they're like, "Hey, we're 100% closing this deal. We just need 20 more days on escrow to push this thing throughout the system." And in return, we'll give more earnest money. And in those conversations, unless there's some time constraint that is super urgent on the seller's end, that is always a conversation that more likely will get approved. So we have seen those where it takes a little bit more time to close, but they ultimately end up getting across the finish line.
That's good. Are you guys seeing much activity from pref groups right now?
There are some folks trying to place it out there. I mean, William, I'm sure you get the phone calls a lot too. Ultimately, my take on pref is if you absolutely need it, it's a great thing to kind of get a deal through the finish line. Be very cognizant of who you're working with. They're more than every piece of that component of the capital stack's a partner, and you should treat that way with your debt all the way up to your equity. But I'd be particularly careful who you kind of get in the hopper with. we're still seeing pretty consistent pricing. Total returns, and call it the mid plus or minus teens on a total pay. They're kind of looking at it almost like value add bucket money though. So in theory, if you don't need it, you're looking at a value add deal, for example, or anything upstream of the spectrum, you're kind of rubbing against your return if you're kind of adding another player to the mix. If you need it, on the other hand, though, I mean, it is liquid. They will, if you find a good partner in it, and they have soft terms, they're understanding of the products, just generally good people. There's money out there, and it's a good little thing to have in the back pocket if you need it.
I feel like everybody's a pref partner now. I've been to a few drinks and dinners with people over the past week, and everyone's telling me that they're willing. Who used to be GP operators or still are GP operators or developers are saying, you know what, we'll provide pref if you have a group with pref. And I mean, I think everybody's willing to do pref, but it's 15% return on money. So I agree with everything Harry just said. It's there if you need it. I would be very selective and careful on who you're partnering up with if you decide to go that route. But yes, there's plenty of people to choose from within the pref. And we've seen a few recent deals. There's two workforce housing deals we closed late last year that did have a small piece of pref on it. So we've seen that execution. I wouldn't say common across the majority of our properties, but it's definitely been there on a few.
Sure. Okay. I'll go ahead and move on to the next slide here.
Yeah, this is just our internal transaction volume from 2023, 2024. I mean, more specifically, this really just snapshots the entire market as far as DFW transaction activity. So in 2022, our market, that was kind of top of the market. DFW transacted $25 billion of multifamily in 1 year. I mean, we've never seen anything like it. That was the highest transaction year to date recorded. Everybody's volumes were up. And then 2023 went down closer to like 8 billion. Last year, the whole market did about 6.5. We did close to, call it 30% of that. And then 2025, as long as there's no more systematic shocks to the system or any crazy tariff trade wars with the pace that we're on right now, I think it's safe to say DFW might be seeing hopefully anywhere between 8 to 10 billion in multifamily transaction activity this year. But we'll see kind of what happens. But at this pace, I think we're going to be up from last year at 6.5.
Sounds good. I'll go ahead and, do you want me to move on to the next slide here?
Yeah, absolutely. So these next few pages are just things that we already kind of covered. You want to just go down. So I thought this would be good to share if you guys want to share this with your audience. I mean, this kind of goes to our point that we talked about earlier about just the net migration in DFW leading the charge at 2.3% year-over-year change. The next slide is going to be a comparison between what we've seen in that delta between mortgage payments as well as rent in multifamily and what's really causing that pressure as far as the necessity for more renters enter into the market. And so these charts are more just kind of more data-driven data points to kind of solidify some of the topics that we already covered. I thought it would be beneficial to add these into this presentation. I think the next one, if you want to go to the next one, this is supply. So 44,000 units last year in DFW, as you see. This chart says 36. We track our deliveries internally, and so depending on what third-party report you look at, some of them say 36 this year. We've actually have an internal database and have driven every single deal that is going under construction or permitted and have a shovel in the ground. Once you tear through the data, what you're going to find is you're going to find a couple thousand unit delta. And a lot of that is just due to a lot of these projects are, yes, they're permitted, but they're not going to be opening their doors till next year. So you got to factor that out of the equation, as well as a lot of these deals are going to be either coming online in Q4 of this year, but really 75% of their units, assuming a 12-month lease-up velocity and stabilization period, they're really going to be going through lease-up next year. So if you take that equation and factor in those two things, you kind of get a little bit of lower number than what we're showing here. So this year's going to be 32 to 33,000 units, and then next year is about 20,000 plus or minus 20,000 units as far as supply, which we kind of already covered. So.
The number that, and Hayden, feel free to jump in, but the number I'd seen as far as rent growth for this year, I think for DFW, this is per real page, I think Hayden, was it 1.8% or something like that? Does that sound kind of ballparkish to you guys, or do you have kind of internal number or other data that kind of supports that, or is around that number, or completely off? Or
Yeah, I honestly, it's too early to tell. I wouldn't be surprised if we end the year at a higher average percentage. And I say that because including us and everybody, third-party marketing reports, I mean, they're getting their data based upon kind of what the trend line's been over the past 12 months. And it's been pretty choppy. Rent over the past year has been flat, if not 1 to 1.5%. I can say that we are right now seeing really strong positive signals on rent rolls, on box scores, and on delinquency reports. We're starting to see concession reports come out that are discontinuing concessions. A lot of that data and those property operational enhancements have not fully baked into the P&Ls yet. We're not seeing that correlate into the P&Ls. I think that's something that's going to be coming in and being solidified as we, continue to have the supply pipeline bleed down as we continue to go into the summer. So we're getting on all 9 of our deals that we have on the market, or the 8 that we just ran best and final on. I would say 95% of them, we're getting updated rent rolls box score almost daily, and they have been very sticky and showing very positive signs. So I would anticipate that to be fully baked in the next couple of months, and hopefully that continues to improve. So.
I had a follow-on question. So of the buyers that, looking at these, you mentioned there, I think all of them that you guys are doing the best and final on are all, I think, 90s and newer, or most of them are 90s and newer. Are you seeing people project rent growth in their underwriting or anything like that over the next year or so, or what does that kind of look like?
Yes, we are. So most people will, in their underwriting, they'll do a value add line item. So if there's any kind of just low hanging fruit on the value add side, let's say pet yards where they could easily, an easy clear cut plan for that, or covered parking or whatever it may be, they're going to add some type of value add rent growth for those specific units that could have them, as well as on the organic side of the equation. And on that line item, we're seeing people hold rent relatively 1-2% in year 1, and then hockey stick it up into year 2 and 3 and 4. So we're seeing people give organic rent growth and hockey stick it up in year 2 with the mindset that, hey, it's going to be relatively flat, 1 or 2% for the first year as we continue to push the supply through the system. And then we're going to be looking at a more healthy rent growth of 3 to 4% in year 2 through 4. Honestly, looking at, and talking to a lot of the professional equity out there, and the reason why I think a lot of people are trying to buy right now in DFW is they're wanting to get in front of this operational enhancement wave that they project coming due to the supply dynamics that we already talked about. And nobody's underwriting to this, but I wouldn't be shocked if people model up the deal with, 2% rent growth year 1, 3-4% in year 3 through 4, and we see a short window of 18 months from 2026 to 2027 where we're getting higher organic rent growth than that. I don't think that's off the table. Now, you can't underwrite to that, and that's not what people are predicating their values off of, but I think a lot of people are saying, hey, they're looking at their model saying, man, these rent growth, if the supply dynamics in DFW have as big of an impact as we think it might have on operations, our model might be outperformed as far as rent projections, and our 14 IRR just went to a 17 just by outperforming that. Now, it's nothing they're banking on, but I think that's a possibility, and I think that's what we could see in a couple of years.
Yeah, to that point too, I think some of the folks, they did work through the kind of the peak of 21, 22, and acquisition people are using some more aggressive assumptions back then. They still have to abide to a credit committee in often cases. Some of these assumptions are putting in, they're ironclad, right? So they know they can get that return. They feel very comfortable with it. And to William's point, we probably will be pleasantly surprised if we get this awarded to us based on our assumptions being a little more, kind of playing almost gloves up a little bit, but on the offensive again versus a couple months back.
Yeah. And what we see, I mean, once we do see top line rent growth, I'm a very firm believer that we're going to start to see that this year, and that be stronger than a lot of people think. I think that's going to impact rent growth assumptions for buyers, next year, because you have a really strong trend line on T12 that people are going to underwrite to. I mean, to Harry's point, like back in 2022, 2021, rent growth was off the charts, 7-8%. I mean, you saw a lot of people be like, okay, we're going to underwrite to 4 or 5% rent growth and call that conservative because they're going off of the trend line over the T12. And that also included, that was one of the variables that resulted in elevated pricing at that time. So I think once we start to see that hit the books, you're going to see people's underwriting become way more aggressive. And I think it's inevitable to happen just looking at all this data and the writing on the walls. So.
Yep. Yeah, we definitely agree with you there. Given that the supply and demand dynamics is such a big piece of this puzzle, are you seeing, especially in DFW, maybe some submarkets absorbing it better than others, or maybe are there some that you're still seeing are struggling?
Yes. Great question, Hayden. I should have, one of the things I just realized, we have a really good chart, and I'll send it to you guys afterwards as far as deliveries by submarket here in DFW. Allen and McKinney in that 75 corridor was the highest concentration of supply that we saw here in DFW. I mean, they're going to be going through that submarket. It's submarket specific. That market received the highest level of supply from 2024 wave. Pockets like Arlington is a relatively low supply market. And so there are markets, depending on how much supply got delivered last year, that are still seeing softening. And I'd be happy to share that graph with you guys after this. That kind of breaks out each submarket. So.
Yeah, that'd be great. Are you guys seeing any HFC or PFC deals coming out, or I'm sure some BOVs that you guys are looking at? What is do you have any out, or just curious what the appetite would be potentially for those, or it might be TBD depending upon the legislation, but.
Harry, do you want to take that, or is that the ongoing conversation?
Yeah, I can take that one. It's always a fun conversation on the debt side now too, especially. So I think I think you guys have one coming soon, so there will be a data point on that. You can speak to that a little bit. But there's one pending, so people are starting to maybe shop them a little bit. I will say the liquidity, in my opinion, if I were to have the crystal ball when it starts to kind of go out in the sale market, liquidity in those kind of domiciled, local authority, housing authority, PFC, HFCs is going to be substantially better than what you're seeing with these traveling HFCs. And a lot of it's to do with where I'm sitting on the financing side. Whether or not some of these bills, like I think there's House Bill 21 sitting out right now, for example, that is kind of eradicate the traveling HFC concept, whether that gets through or not, from a lender's view, they see two things on the wall there. A, if it goes away and it's retroactive when we close this, then our loan's immediately impaired. B, if it doesn't go through and say, I'm, guy in the housing authority in Irving and somebody in, let's say, a different housing authority is in my backyard, and I can't get this thing off my plate, I'll go and try to sue that said housing authority, or I'll try to get a restraining order, or, you know, I very well may sue the asset or the lender. So there is the potential for risk, you know, with that kind of cross-pollination still, which may inhibit a little bit of the liquidity in that market. Now, for those loans that are, you know, assumable, or, you know, that have a reset with the lending leverage or something like that, those will have liquidity. I just think that level will be substantially lower than those kind of, you know, Fort Worth with Fort Worth Housing Authority, or, you know, the local types that are kind of the traditionals. And, you know, to that being said, you know, those ones with the traditional style are viewed as, you know, generally okay. And, you know, you can get long-term financing on them still to this day. So there is a positive there. And typically what happens with those is the AMI constraints and the kind of affordable housing constraints coincide with actually what is needed in that area. So you aren't getting as many of those, you know, questions of, you know, we're not really adding any value to you're just taking off the tax roll. So it's a long-winded way of saying I think it's going to bifurcate a little bit between traveling and domiciled, in how, you know, how hot and, you know, not hot they are out in the market when they go to get sold.
Yeah, I would agree. The concept is relatively new, and so there's really not a whole lot of data points that we could point to say this is what the exit strategy is going to be. It's a relatively newer concept. There's been one deal in Princeton that got to the closing table recently. That was a PFC HFC transaction, and then there's one deal currently on the market. We got one coming down the pipe here soon as well. And so the data points on the board is very minimal as far as the buyer pool biting off on current in place PFC and HFC structures. I mean, we could run the math and assume you need to be 25, 50 bips higher than market cap rates. But that is just kind of unknown territory as far as a sale process and buyer pool biting off on that product type. So.
Gotcha. Okay. Sounds good. I guess we're getting, you know, close to time, and we want to be respectful of y'all's time and all that. Any kind of anything you guys want to close out with, or you know, or if you want to leave your contact info or whatever's you know, best for you guys. But we just really appreciate you guys hopping on. So really been really been great to just hear your insights and hear what's going on in the market. So
yeah, no, likewise, and it's always great catching up with you both, and we look forward to continue working with Momentum team, and we really appreciate y'all's time. My contact information, my email is whubbard, so WHUBBARD @IPAUSA.com. You're more than welcome to reach out to me on my cell at any time, 214-298-2148. And then if you need any debt guidance from Harry's side of the equation, our line is always open. We work really closely with Harry. So if you're talking to one of us, you're talking to all of us. Harry, you want to give your email and contact information?
Yeah, I just dropped it in the chat. So it's the same thing. It's first letter of my first name, hkrieger@IPAUSA.com. But if you want to grab it, you can copy it out of the chat. But awesome. Yeah, happy to help in any way to anybody on the call.
Awesome. Yeah. Well, really appreciate y'all's time. Hayden, anything else you want to wrap up with you can think of?
No, yeah, just really appreciate you guys. It's always interesting to kind of see where the market's headed, and what's going on. So I appreciate you guys sharing all this information with us. And yeah, hope to chat with you guys again soon.
All right. Well, thank you, everyone. Appreciate you guys being on.
Yeah,
have a good day.
We're here if you need us. Thank you.
All right. Thank you.
Have a great day.
See you, Harry. Thank you, William. Take care. Bye.